Hey everybody, welcome to this free edition of our Trader User Group's weekly roundup. This is for the trading week ending May 15th, 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is rope-a-dope. And let me just kind of go through what I'm really talking about here. But you probably notice on this front screen, I've got a saying here that I use with our members all the time. Don't be a rat brain trader, be the red striped zebra. Trade smart. What does that really mean? It's more of a contrarian philosophy. And we really don't want to follow rat brain traders, which are basically the retail trading group. Generally, this is why put call ratios usually work very well. This is why the skew gives us a good idea of where we should be loading up, long or short. It's more of a philosophy where everybody is generally, if they're mostly bullish, then you can pretty well bet the market's going to roll over. And if people are leaning towards the bearish side, then the markets want to climb higher, climb the wall of worry, as they say. So for our members, one of the successes that we've had, which kind of underlines our whole approach, is being the red striped zebra. We want to stand out from the herd. And we always do that with the strategies that we use. So now, just kind of introducing this to you, what I want to do is just kind of go through where we are for this week. So, excuse me. Let's take a look at the index performance. If we look at the index performance weekly, we've seen the Dow, S&P, NASDAQ, and the Russell all down for the week. You know, the Russell really had the worst loss. It was down 5.48%. NASDAQ was the best performer. And if you look at year-to-date performance, and I didn't put the minus out there, but the S&P, the Russell, and the Dow are all down. And the NASDAQ is the only one that's in the green for the year. It's up 47 basis points. It was up a little bit more than that, but the Dow is down a little over 17%. S&P is down about 11%. The Russell's down a whopping 24.64%. NASDAQ, as I said, is up about 47 basis points. If we look at the best sector performance for the week, healthcare was the best, XLV. It was up a little over 1%. Worst performing sector this week. Now, I remind you that energy's finished in the top for the past 3 weeks, and then we just finally gave some of it back this week, down about 7.5% or so. If we look at the world indexes, if we look at Europe, the FTSE, CAC 40, and the DAX across Europe, FTSE, the London index, it was down a little over 2%. The French Paris index, CAC 40, it was down about 5%, 5.98. DAX was down about 4.03. And if we look at the Asian markets, the Nikkei, it was the Nikkei was actually down just barely. Okay, it was down about 70 basis points. China was down about 93 basis points, and the Hang Seng, which is a Hong Kong index, was down 1.79%. And then if we kind of swing back to the US and look at some valuations here, you'll see the trailing 12-month PE ratio for the S&P is at a whopping 24.56. The forward PE ratio is at 22.69. So clearly the forward PE ratio, is a little bit higher, a little bit lower than the trailing by about 7.6%. And then of course we can see the dividend yield in the S&P is sitting at about 2.12. 10-year treasuries at 64 basis points. So that gives us a spread between the 10-year and the S&P at about 148 basis points, or 1.48%. That's a big spread, folks. That keeps the money flowing into the U.S. equity markets, okay? Now, if we come over here and let's just take a look at some weekly sound bites, things that I see happening during the past week and things to come about. You can see here this little saying I got out of Barron's this weekend. The only good news about the economy is that it's hard for the bad news to get much worse. If we look at it, we've seen retail sales really suffer their biggest decline on record. They were down about 16.4%, along with plunging CPI data, industrial data, a whole host of data just really got crushed. And basically what we've got here is a market. And you may be thinking, well, heck, why is the market doing so well, taking all these body blows and yet holding up pretty good as the economic data just comes in so ugly. And it's what I call the rope-a-dope strategy. You guys, for you boxing fans out there, may have remembered Muhammad Ali had this rope-a-dope where he would just sit on the against the ropes and let the opponent just wear himself out by trying to hit him in the body and the face. And then around the sixth or seventh round, when the opponent's kind of worn down, then Muhammad Ali would come in and just really start ripping them apart. It was called rope-a-dope. Get him up against the ropes and then just let the dope kind of wear himself out. Well, in many respects, the markets have kind of done that same thing, right? I mean, they've just really kind of let the markets pound away with really bad economic news and yet still move higher. So now, if we look at where we are sitting right now, the markets are up about 28% off the March 23rd lows. Now, we're down 3 of the past 4 weeks. And as I've told our members and I've told you guys here for the past 4 weeks, I said be ready for a little bit of a pullback. In fact, I was talking about a pullback down to the 2600 to 2700 level. And as I said, 3 of the past 4 weeks we've been down. So the question is, are we going to go lower or are we going to have a little bit of a rally here? Well, keep in mind, one of the things that have moved the markets up, we've just had a tremendous amount of stimulus pumped into the markets. And central banks are already using negative interest rates, but it hadn't really done any favors for them over in Europe. Or look at how it's worked out in Japan. I mean, they've been trying for decades to climb out of this inflationary or this deflationary hole that they've kind of found themselves. Really, really just tough stuff. So I still believe that over the next 3 or 4 weeks, we're going to find ourselves lower rather than higher. But we're still in a very choppy market. I'll show you the charts here in just 1 second and just kind of how they're kind of shaping themselves up. Okay. But one other thing that has surfaced this past week, and you guys may know what it is, but this old threat's resurfaced. U.S.-China relations. Clearly, the COVID-19 has kind of spurred that along. But it's going to change risk models as we go forward. I mean, if we looked at last week, and Trump's rhetoric, it's just really heightened. I mean, just as an example, earlier in the week, this past week, Trump came out and wants to prevent U.S. Fed funds, the U.S. government's thrift savings plan is like $4 billion of it, of which 10 or 15% is invested. There's a lot of Chinese stocks there, and he basically told the managers of the thrift fund to sell those stocks. Okay, so that's number one. The other thing that's going to happen is by the end of the week, we saw U.S. I think it happened on Friday, U.S. curtailing Huawei Technologies' access to semiconductors that are used by U.S. technology firms, right? So China had came out after that comment and said that they may retaliate against this move, and their way of retaliating would be to go after U.S. companies based in China like Apple or Cisco, maybe some of these other companies. So that rhetoric has increased. And with that increase in rhetoric, it's going to add another element of risk, I think, on the go-forward basis with the markets. And that I think everybody had kind of already forgotten about until this past week. And I think it's going to get worse. I don't think it's going to get better. Okay. But I think the markets are going to be basically assuming that Trump wants the markets to hold up a little bit. So I think he's going to have to balance tougher rhetoric with China versus keeping the markets in tow. But I do believe that we can have a little bit of a pullback here. All right. And I've been talking about this now for 3 or 4 weeks. And then one other thing I wanted to talk about here, and for our members this Sunday night, I'll go into more detail with a list of some stocks that I think will work out really well. But some of the data I'm seeing on hedge funds over this past week, larger money managers are beginning to take profits in some of these stay-at-home stocks. Like Slack or Zoom or Netflix or Peloton. Some of these stocks have done really well over the past 3 or 4 weeks in this COVID pandemic crisis because people are now forced to work out of their homes. But a lot of the juice has already been chewed out, or the flavor has been chewed out of the gum. So I think you're going to see some hedge funds slowly start to take profits in some of these. And they're going to move money. And where are they going to move money to? Well, they're probably going to move it really into those sectors that I think have performed the worst, like travel and tourism. And there's a list of stocks that we'll review this Sunday that I think are going to be really interesting plays over the next, let's say, month or two, as the markets start to rebalance. I still believe there's more downside risk than upside risk in the markets. I think the markets are limited upside, and downside risk is probably about 3x of upside risk. So basically, an upside move would be something like 3 to 5%. So if let's say 5%, that means the risk of a downside move is 15%. From where we are right now. So there's going to be a bigger risk, usually to a factor of 3x right now, downside versus upside. So that's kind of where we're focused as we speak. Now, what I want to do is shift my screen over. So just bear with me as I repaint the screen, and I'm going to take you to one of the charts that I use a lot, which is really the, this is the 240-minute chart of an Ichimoku with the E-minis on it, okay? And on this chart, it really gives you a good, almost close to a daytime frame trade, but it gives it what I call kind of an X-ray vision, right? I mean, it really zooms in a little bit better. And if you look at this, you can see here that we're still on an Elliott wave 3 down here. And as I've been telling everybody, I think the downside risk is much lower, somewhere down in this area down here, okay? And we did have this move lower like this. I mean, that was, just I think an easier call to make on our part and my part in doing this. And when we crossed over the 50 line of the RSI, then I think we're going to stay down here a little bit. We're trying to climb back up here, but it's going to be very tough. You can see some sellers came in here, but we came back in right here. And we're now back into what I call my R1 zone, which was a resistance zone for quite some time. And we've been moving in and out of this zone for quite some time. I do believe we're going to come back down into our S1 zone, possibly even lower. But like I said before, I do not believe we're going to make new lows. Now, why do I say that? Now, I've talked about this before, but let me just change the chart here and let's look at a clean chart or a cleaner chart. And this is a daily chart of the S&P 500 E-mini futures off the lows that we made on March 23rd. You can see here, I've got Fibonacci extensions that run up. And traditionally, with every bear market that is hit, anytime we get over the 50% fib node, particularly around the 55%, that means the lows have already been made. At least in the past recessions that we've had, going back over 70 or 80 years, every recession that we've had, every bear market that we've had, if you measure fib node extensions off the lows, and if we move above the 50-55% node, then that means the low is in. Does not mean we can't pull back and bounce around here before we move back higher again, but we've never had this kind of situation where we make new lows when we move up this high. So assuming that is the case, and assuming the past is a prologue to the future, not exactly, but similar, right? Then you can see here, we actually moved above the 61.8% extension off the lows. So that tells me that I feel good so far that these lows have been made. Now, what is this line right here? This is, as I've showed you before, this is a trend line that goes all the way back to the March 9th lows in 2009, okay? And that tells me that we've probably got right now, that would be a hard low for me. You can see right here how it was kind of a hard low. We blew through right here, but we quickly came back up and found support at that line. So this would be a hard low for me. But you can see a typical extension is around 3.8 or 38.2% to the 50% level. Now I've got these little indicators on here that just give me a general idea of a Elliott wave 4 pullback. So one of the things I'm telling our members is we closed Friday at 28.54. If we get back up over the 2900 level, and the 2900 level is back up really over this 61% extension off the lows. If we get back up here and it serves as support, then we're going to come up and challenge these moving averages. And I've got a particular target here that's sitting around the 3,000 to 3020. Even if we come back up to this level, it would give us an Elliott wave 5, okay? And then from that perspective, I would see we would give it up like that and then come back down and test these levels again, keeping in mind that I don't think we're going to make these new lows. Now, what could put us back out in this level as we move forward in time? Remember, Q2 is worse than Q1, and we only got a taste of it with the Q1 data that we got with GDP down a little over 4%, right? Because there was only about 2 or 3 weeks of that data was included in Q1, and yet we were still down. So we're going to get it a lot worse. So I do believe we're going to come back down again, but I think not until we get some people suckered in. But I do believe we're going to see some lower price action here on this chart. Okay, so I wanted to just kind of point this out to you guys and where we're sitting. Now, another thing I'm going to point out, let me just blow it up just a little bit on the screen so you can see it a little bit better here. So let me just get this down here and let's just kind of get it centered on the screen here. These are moving averages. Now, people just throw out moving averages, but there are really two basic types. They're exponential moving averages, and then there's simple moving averages. Most of the big money and the big boys, they generally focus on the simple moving averages, okay? This is an SMA, a simple moving average. This is a simple moving average. So this is the 50, and this is the 200. And you can see where typically when we're in a bear market like we're in now, and you can see this has pretty much gone flat. The 200 EMA is going to eventually, if we kind of hold these levels, is going to go flat, and we're going to railroad track this thing, okay? And generally, when you come up and hit the 200 SMA, markets bounce off and come back down again. And you're going to find, I'm going to shift to EMAs and show you the difference. The EMAs are basically a little bit tighter, right? They're a little bit closer. You're going to see the 200 SMA move lower when I change it to an exponential, because an exponential moving average basically weights the near term moving average is a little bit stronger than the farther out in time. A simple moving average just takes 199 days ago, and it's just as important as the trade action today. An exponential moving average weights the current daily trades a little bit more weighted than the 199 200 days ago kind of thing. So you'll see how it's more sensitive to the movement of the stock. So I'll show you the difference in a minute. But if we look at these generally in bear markets, moving up to the 200 EMA as a prescription for the algos to fire off and start shorting again. Coming down to the 50 EMA, it's a prescription for the algos to just start buying again. So we're going to be in this kind of wider range. And you can see the 50 EMA is sitting around 2,700 right now. All right. And I had said anywhere from 26 to 2,700, 2,600 to 2,750. Right in that area is kind of where my target was, right around this bubble right here. That's kind of what I was looking for. Now we got down there, we got down to the 2750 area fairly close at the upper end of my bubble or my range, but I think we're going to come back down there. Okay. Remember, we're making lower highs as we go forward in time. So if we take these levels out and then we can hold it, we're going to hit my near-term target here of around 3,000. But I'm still looking at, as again, as I said, it's a 3x risk. The risk of a bigger move is 3x to the downside compared to a 1x move back to the upside. So you need to treat your portfolio that way right now. For our members, we'll go into some stocks that I think make more sense to the upside, some ways to hedge this more to the downside. Some of our members are hedge fund guys, so we kind of just talk about some of the things, and I talk about some of the things that I see in the markets here and kind of where they're running. We've also got a new trading system that I'm going to introduce to you from a membership standpoint. Members get it for free, but I'm calling it our Morpheus system. For those of you that were Matrix fans, you understand who Morpheus was. He was kind of the spiritual guide to Neo, kind of, helping him along the way. Do you want to take the red pill, blue pill kind of thing? The red pill being, truth and awareness, and the blue pill being just oblivious to everything like the rat brain trader typically is in the market. So this is kind of where we're sitting right now on this trade. And if I were to kind of just blow this up a little bit, I can show you a couple of different views here on this daily chart, right? I can put this in like this, right? And then just connect the neckline like that, and you get the left shoulder, you get the head, you get the right shoulder over here kind of thing. Now we came down to the neckline. This is viewed as the neckline. We came down to it, but we really didn't break it. If we had broke, the measuring objective would have taken us down to the 2600 level very easily, but we didn't break. Now that's not to say we can't, camel hump this thing up and then finally break. That would disregard the pattern here, but I'm still sticking to this move down here. Near term though, if we do come up and we broach the 2900 and it holds, that's where we're going to move, okay, up in that area there. But that's not to say that it's going to be able to hold. All right, that's just, and then just wanted to show you. Now again, if we come in to a 240-minute chart and I put it on the Ichimoku, you can see there's a green cloud up here and then it switched to a red cloud, which means it's more bearish than bullish going out in time. The cloud serves as a resistance level that we have to punch through, like really strong hedges, or a strong hedge and brush and bush. If you're out in the jungle and you're trying to get chopped through it, it's very difficult to do, which means it's just only going to push it down a little bit, okay? So this is kind of where we're sitting. Now, if I'm going to switch the screen over, and what I'm going to show you now is the same chart, but just marked up a little bit differently, but using exponential moving averages, okay? And if we look at the exponential moving average, let me just kind of, it's going to take a second to paint over. Let's see, what screen number is this? This is screen number 5. I got a dozen monitors on my desktop here, so I just kind of trying to find the right monitor is just kind of crazy, right? So if we look on here like this, you can see now on this chart right here, it's again the E-mini futures daily chart, but now look at the red and the yellow line. The red line's the 50 and the yellow line is the 200. Now this is an EMA. Notice on the prior one, the yellow line was north. It was up in this area here. But now the 200, this is the EMA rather than the SMA. And you can see right here how we're hugging it and we can't get over it. We actually closed one day above, but we really went below it right now. So this tells me that algos are tuned into the 200 EMA as well. Here's the 50 EMA. And you can see with the 50 EMA, it's kind of holding that level right here, okay? The last time we closed for more than a few days below the 50 EMA was the end of April, all right? Around April 21st kind of time frame. So we're still hugging this line. And this would mean the 200 EMA is sitting at 29.32, the 50 EMA is at 28.29. And we're nearer the 50 than we are the 200. But we're going to be in this chop. And I promise you one of these levels is going to break. The odds favor a break to the downside. But if we break up, I told you that area that we're going to run to, which is right up to this area here, which is near the 200 SMA, right? Which is also the distance calculated by a fib node extension off the lows as well. So this is kind of what I'm looking at here on these markets. All right, so I just wanted to give you a couple of different views from a couple of different indicators, but they're all lining up and saying pretty much the same thing. Okay, if we come down here and we look at volatility, again, volatility can either be your worst enemy or your best friend. It depends on your understanding of volatility and the skews. And if you look at these skews right here, you can see we've moved back into the red zone again, which is over 30. I've got it colored red for a reason. And then up above is black, which is really signified for black swan. Okay, but we've come down a dramatic amount. I mean, if we look at this, you can see at the height of the pandemic here. Let me just get it back up where it should be, just like that, because I grabbed the wrong thing here. But you can see at the height of the pandemic, we were way up here in the 85 area, and now we're back down again. So we're coming down, but just like 2008, 2009, as I told you guys, even if we have a rollback over again, volatility is not going to come back up to this level. The odds favor to come back up into the 50s again if we get a spike down to 2600, 2650 area, but I don't think it's going to be as high as this. It'll probably come into the low 50s, and then it'll sell back off again. But once you get volatility over the 30s into the 40s, then that basically means we're going to be stuck with high volatility for at least 6 months to a year, right? Because volatility is going to stay elevated for fear of having another rollover. The market makers are just going to price a premium into the option contract. But we're still at an elevated level, so we got to be very careful, okay? And now the interesting thing is if we look at the front month skew, okay, The front month skew is riding the curve. In fact, we actually closed in a contango environment. You can see we closed just barely in the green. So that means the VIX is slightly higher, or I'm sorry, slightly lower than the front month vol futures. And then if we look at the back month skew, which goes out June and July, you can see we're basically barely in a backwardation. So there's still fear out there going June, July, and August timeframe. Okay, so that just means we still got to be extremely careful, guys, just looking at the skews with volatility. Now, if we come over and look at the bond market, and we just kind of see what the bonds are doing, you can see we've been running flat here. I don't see bonds going up too much higher. If they do, I'm going to be an active seller of bonds. I don't see them going too much lower because the Treasury is going to be issuing new bonds, um, gosh, every month for the foreseeable future, because they got to finance this debt, so they got to issue bonds. But you know who the biggest buyer of the Treasuries are now? The U.S. Treasury. They're buying about 60 or 70% of them. So they issue them and then they buy them. One hand feeds the other, one pocket out, one pocket in the other. So that just means we're going to keep bonds in a tight range for a bit of time. Okay, now we can have these spikes like we have over here when we have a downdraft, a hard downdraft. But um, the bond market is going to be interesting, guys. There's going to be some really great trades coming up in the bond market. And members, we're going to be watching. And of course, if we look at the US dollar, right? If we look at how the US dollar is doing, it's still maintaining its upward cant here. Like bonds, we're in this kind of sideways pattern right now with the US dollar. The dollar is still very strong, okay? And this big move here was showing everybody wanting dollars when we had that big sell-off. So the dollar is still where you want to be internationally, right? It's just the dollar is the currency of record. International transactions, I think 65% of all international transactions country to country are done in the US dollar. That benefits us right now. The yuan sold off big, and I know China would love to replace the dollar, but that just ain't going to happen. Not in the next couple of decades. Of course, if you leave it up to our politicians, anything can happen, and they can, they need directions to back out of their damn driveway. So hopefully they won't screw it up. But longer term, if American citizens keep doing what they're doing, then they're just gonna, they're gonna believe half the garbage that spews out of the mouth of most of our politicians anyway. But this is kind of where we're sitting right now in the markets. If we come down here, let's look at gold. Gold, guys, longer term is bullish. Okay. Um, there is no inflation on the horizon for the next year and a half. All right. But I do believe in the next year or so, we're going to see gold over 2,000, possibly up to 3,000 in the next couple of years. It's going to be fraught with up and down chop, but you want to be able to have just a allocate a portion of your portfolio to gold. And for our members this Sunday evening, I'll go through some ways that we can play that. Okay, that's gold. If we look at copper, copper with China, China is starting to come back on again. As I was, even you guys, I was telling you this weekend on my blog, Weekly Roundup, I was saying you got to go long copper, and there's ways to do that. As I showing our members, as China comes back, copper comes back. They're one of the bigger buyers of copper globally. You're seeing it's going to chop. We may have a little bit of a dip, okay, but on any dip, use it to buy. Okay, and there's other precious metals and other things that we're doing in this area that I'm not going to go into now. Members, this Sunday evening, I'll go through it. Let's look at oil. Oil, right? Now I've got the zero rate on here. You can see how oil has moved up. Um, and it's done really well. Now we're playing oil to the long side, but I showed our members how to do it the right way, not the wrong way. It's so easy to get trapped with oil. And if you just trade some of the old standbys, you're going to get killed, guys. You got to know how to play oil. And there's some great way for us to play this to the long side. And that's what I'm working with our members on. The other thing that I talked about was natural gas. If you look at nat gas, as it comes back down here again, it's going to set us up for another trade. Okay. They're cutting rigs left and right to get the production down, to get the inventory levels down. And I think that's going to result in a counterproductive move higher in both nat gas and oil, not in the near term, but longer term out, because oil and natural gas, you can't just adjust it right away. The things that you do today affect the price 6 months and a year out in time. So there's going to be a time and an effort here for some really great plays. Same thing in natural gas. Okay, if we look at gasoline futures, you're going to see here with gasoline futures, it's the same kind of thing. Let me just get this off my screen here because it drives me crazy. Let me just come back here. So you can see with gasoline futures, it literally got down to 37 cents a gallon. I mean, that's how ugly it got. But notice with gas futures, we didn't have that negative rate that we had in oil. Oil is all about storage. Okay. Gasoline futures, they don't have that issue. I think gasoline futures is slowly going to be coming its way back up. There's ways to play gasoline futures. The futures market right now, it closed the week at about 97 cents a gallon. Okay, on the futures market. And I just think it's going to move higher over time. So there's going to be some great ways to play it. There's some other good things coming up in ags, meats, and the soft market. So members, as soon as some trades really surface there, we'll take a look at them. Meanwhile, everybody, I will see you in our weekly market watch for members this Sunday evening. For those of you that are just gassed and just looking at the video, I would encourage you to come in and sign up with us. We've got this new trading system that we're also testing out. We're going to be using. We're going to be tying it in with Thinkorswim. And I call it Morpheus, and it really works well. We've had a lot of folks that like to day trade, and it's just rocking on a day trade standpoint, but it also works well on different time frame pairs. So otherwise, everybody have a great weekend. Keep in mind, next weekend is Memorial Day weekend, so I'll try and get something out, but I'm not really sure yet. I'm moving my office up to a top floor where I'll have a beach view for the office, so I always want to be able to look at the beach when I'm playing in the markets. It's kind of a nice thing to be able to do when you're down here in South Florida. So that's a little bit about where we're sitting. All right, everybody, have a great weekend. And, just as a reminder, don't be a rat brain trader, be the red striped zebra. That's kind of what we're looking at. So trade smart, everybody. Have a great weekend.